Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be touching base on the NASDAQ and the S&P 500 and really going over the equal weighting and the breadth of this market. I think it's important to start with the NASDAQ, the QQQ, because the NASDAQ actually made a brand new high today. So that is certainly a positive for this market leading indice as of now. Now, the importance of the NASDAQ QQQ making a new high here, piercing above this consolidation zone, is the fact that when you hit this 327.50, or I should say, if you hit this 327.50 level, you're actually going to be running into the 100 weekly moving average. So there's going to be clear resistance. Now, if you look at this beautiful wedge pattern that is forming on the Qs, I want you to notice that we pretty much, you could arguably say that you did tag that level today. However, if you were to thin out this trend line a little bit and just use the one main pivot high, you can see we just missed it, so which means we may have a likely scenario where the Qs can push up. Now, and looking at the QQQ, it's roughly made up of 100 stocks. And when you look at the NDXE as a equal weighted indice, look at the NDXE not making a higher high. In fact, making a series of lower highs. Here was your high all the way back in February. Look where the QQQ was trading all the way back in February, way down here at 313. And one of the reasons why the equal weighting is so important to pay attention to is because it's showing us that there is selling occurring under the hood. And if it wasn't for the likes of just literally three stocks alone, Microsoft, Apple, and Nvidia, keeping this QQQ up higher, this market would be a lot lower. And when you notice that the breadth in the NASDAQ, the equal weighting, is very, very weak, it's showing that there's still a lot of selling that is occurring underneath the hood. And when the grand weighting of the indice is seeing more selling than just three stocks that carry a larger weighting, that is a little bit of a red flag. I'm not saying we can't go higher, but typically in a bull market, you see the breadth of the market really start to increase. And I'm paying close attention to this wedge pattern on the Qs that is coming up to the main resistance point, which is why we keep seeing reversals off of this key level as we speak. Now, if we look at the S&P 500, the S&P 500 had a nice reversal, recapturing the 1-year orange trend line over here, orange moving average. And the interesting thing about the S&P 500, the SPY ETF, if you pull up the RSP, that is definitely signaling a tremendous amount of selling that is occurring. So the S&P 500 is basically trading above this 153 in this consolidation zone, but the RSP is trading well below the highs. Notice the S&P well above or pretty much close to the highs of the chart, and the RSP is basically way underneath the 1-year orange moving average and well off of the highs. So again, that is showing an incredible amount of weakness, and that is not typically the norm in a bull market when you see a concentration of stocks really getting all of the money flow and becoming absolutely bloated. Even if you look at retail is an important leading indicator for the overall economy, for the overall stock market, and it is triggering bearish breakdowns of this pattern over here. You can see you had a massive chop zone over here where the bulls and bears were in a great fight. Then you had a big breakdown, and now you're looking to retrace to that area again. But even with the market strength in the S&P 500, retail stocks have certainly not been participating in this full market move, which is kind of an interesting relative weakness divergence, which means that if the markets do break down, this is a sector that could see more and more downside to come. And then I think it's important to analyze all of the commodities across the whole, copper specifically getting decimated and looking like it's putting in bearish consolidation to move lower. That is not a healthy sign for copper, because that typically means the economy may be slowing down, and we'll have to pay attention to Dr. Copper because it's so important for our commodity. Even oil has been weak in recent sessions, although it has had a terrific bounce off of the lows, being defended at that double bottom. I do think that it's looking a little bit more vulnerable and tired to move lower. And then you look at steel stocks. I touch base on steel stocks with my members, basically watching for a trigger of this neckline. You have triggered a head and shoulders pattern. They're breaking down. You look at X Steel. That's basically breaking down, slicing through a massive support zone. This is looking exceptionally bearish. We put steel stocks on our members' radars a couple weeks ago, and we've executed some shorts as of recently. Even if you look at STLD, Steel Dynamics, triggering a head and shoulder. So tons and tons of weakness in the steel sector, which is also an important commodity for the overall market. But again, if you just look at the QQQ making new highs and the NDXE not making new highs, making a series of lower lows, it's only a matter of time, in my opinion, before the overall market starts to pull down the other heavier weighted mega caps, especially when the fundamentals of those companies start to go out of whack with the market dynamics. And one of the reasons why tech had a significant rally today was simply because inflation came down, coming in at 4.9%, which lowered the dollar and which also lowered the yield market. So if you take a look at the 2-year yield across the board here, it had a pretty sharp decline, engulfing the previous two candles, still above support, but not looking optimistic. And algos bought up the weakness in yields and basically fueled it right into the tech rally. And then if you look what else, why there was additional strength in tech, the common play that we've been seeing is whenever there's weakness in the regional bankings, which KRE was down about 1% today, you often see that money rotate into some of the bigger mega caps. So pay attention to the equal weighting. If for some reason the NDXE starts to really get a move to the upside, as well as the RSP, then we may be potentially entering a new bull market. But until these equal weighting ETFs start to firm up, it's going to be very difficult for the markets to truly break out to the upside, especially when you think that the weekly 100 moving average on the Qs is basically right around this 327.50. So thank you all for tuning in. Please give this video a big like down below, and I hope you enjoyed and helped your analysis in making some decisions moving forward. Definitely be mindful that PPI is tomorrow, as well as some initial job loss claims. So that again is going to be market moving for the overall yield and dollar market, because the market is still very sensitive to the employment data, considering that is what the Federal Reserve looks at. Take care, everybody, and we'll see you on the charts tomorrow.